Good morning, ladies and gentlemen. On behalf of myself and my team, I'd like to wish you all a warm welcome today. Developed economies continue to be supported by central bank monetary policy. Now, this monetary policy has been labelled financial repression. And basically, it's a series of monetary tools that central banks use. And these include the purchase of government debt, where the central banks create money out of nothing to buy existing assets, which are UK gilts, for example. And they do this to inject liquidity into the banks and to flatten the long-term yield curve, which brings down the cost of borrowing further out in terms of maturity. And they've lowered bank base rates. And the idea behind this is to provide interest servicing relief and to encourage investors to invest in risk assets.
Going back even further than that in history, about 100 years before this financial crisis happened in 1907 in the United States, there was a big bank panic on Wall Street. And panics or crises in credit and finance, they're really all about the same thing. Someone or some group bets too much, sucks people in, comes out, and everything implodes. And there's some element of what do we do now, how do we pick up the pieces? And in 1907, there was a relationship between J.P. Morgan, who was the most important banker in the United States and arguably the world at the time, who was called upon by the President of the United States, then Teddy Roosevelt, to sort of fix the problem. And I did talk about this in the book before getting into more recent history. And what Teddy Roosevelt said was, here, I'm going to give you $25 million from the Treasury Department in the United States, and just figure out what to do with it to make this problem go away.
So when I think about the fund, I think really in terms of outputs. What does it give unit holders? What does it give our customers? Well, the first thing is it generates a yield of 4.1%. So a yield is the money you get in your hand. So 4.1%, it's like an interest rate. And 4.1 is quite a lot in a world where deposit rates are in the UK not even quarter of a percent. So that's a good starting point. And the fund yields a lot more than a lot of other funds out there. And I think that's a really good place to start. The second output, though, is that income that we pay has grown over time. So over the last 3 years, it's grown by 5% or more each of those years. And it's my ambition to carry on that level of growth.
So how did the banking system and paper money came into existence? Everything started back in ancient Greece when, even back then it was not wise to run around with a lot of gold. So people were looking for a safe place to deposit their gold, to keep it safe. So we had temples which popped up, and afterwards, we had goldsmiths, which basically had, a safe location. Temples had even, defense armies, and it was considered as a safe place. So people were able to deposit their gold, and in return, they had to pay a fee to keep it safe, and they received a warehouse receipt for the amount of gold. And that's basically also how paper money came into existence, because, as we said, the paper claims used to be a property title for a certain amount of gold. But, greed was always a problem. And the first fraud, based on history, happened 300 before Christ, when basically the goldsmiths realized not everyone is picking up his gold. So basically I can start, to lean out gold physically, which he was not allowed to do so. Or he could basically issue more paper claims and earn an interest on that. That guy was brought to court 300 before Christ, because this scam used to be called a fraud. But today, when we look at our fractional reserve system, it's basically becoming today's system.
So, an overview. The returns are underpinned by biological growth. The trees are in the ground, they're growing. Rising timber prices are your potential upside. There's been a track record, as you can see at the bottom here, of very strong returns with low volatility. I haven't put gold on there, but I think Claudia and I were talking, I don't think we'd fit the gold return on that graph, but you can see compared to other more mainstream asset classes that forestry has performed well and with relatively low volatility. Inflation is back in the news, 2.3% this week on conservative estimates. Most forecasters expect it to be 3% plus by the end of this year. Forestry acts as an inflation hedge. The trees we're dealing with are primarily Sitka spruce, as I mentioned, conifers. They have a flexible harvesting window, so it's not like you're a farmer, you've got a crop of wheat every year, you've got to harvest. Doesn't matter what the weather is. If the weather's been fantastic and there's loads of wheat, prices depressed because there's too much. If the weather's been terrible, you haven't got much wheat to sell, but you've still got to sell it. Here, we can leave our trees on the stump if timber prices are low. What are we selling our timber into? The domestic timber processing sector is a bit of an unsung success story, really. About £1 billion has been invested over the past decade, and if you think of what else has gone on in the world in the past 10 years, to have such significant investment is quite an achievement. 150 million more that's actually happening at the moment.